Hey there, happy Wednesday. Welcome back to this week's market update. And wow, there's a lot to unpack today. We've got everything from a state attorney general being indicted for mortgage fraud to Fannie Mae changing the game on qualifying income, all the way to Jerome Powell hinting that yes, moves there are coming may push mortgage rates even lower before the end of the year. So let's jump straight in. So this one's been all over the news and you may have heard about it. New York Attorney General Letitia James has officially been indicted by a grand jury on 2 felony charges: bank fraud and false statements to financial institution. Now, this is the same Letitia James who's been in an ongoing feud with President Trump for years, and that indictment comes just after he publicly pushed the Justice Department to pursue charges against her. In response, James called it a desperate weaponization of the justice system. Regardless of the politics, this marks the first time in years that a sitting state attorney general has faced mortgage-related criminal charges, which is something that could have broader implications for how regulators and prosecutors handle fraud in the lending world moving forward. It's definitely a story to watch closely. All right, here's a big one that's going to directly impact buyers and loan officers. Fannie Mae will now allow rental income from ADUs, or accessory dwelling units, to count towards qualifying income. This is a major change. It's effective immediately for purchases and limited cash out refis. Here's the breakdown in plain English. The ADU income can make up to 30% of the borrower's total qualifying income. It only applies to one unit primary residencies. You can count income from just one ADU though, not multiple, and you'll still need standard rental documentation like a lease or a market rental analysis. For those not familiar, an ADU could be a guest house, a basement apartment, a detached unit, even a manufactured home that's on the same lot. It just has to have its own sleeping, cooking, and bathroom space. It's a big deal because it helps first-time home buyers and multi-generational families who might be stretching their budgets, and it gives realtors a new way to market properties with income potential. If you've got listings with ADUs or homes that could add one, this is your opportunity to highlight that potential. Next up, the HUD layoffs. HUD announced it's preparing to lay off 442 employees in December following weeks of furloughs during the ongoing government shutdown. The hardest hit areas? The Office of Fair Housing and Equal Opportunity, with some entire teams being eliminated, including those in Denver and in San Francisco. That means large portions of the West will temporarily have no local staff investigating housing discrimination complaints. Now, officially, HUD says the layoffs are meant to align programs with the administration's priorities and available funding. But internally, there's concern that these cuts are weakening of fair housing enforcement. A whistleblower even filed a complaint claiming that agency has deprioritized disparate impact cases, those where housing practices hurt protected groups, even if unintentionally. If that's true, we could be seeing the biggest rollback of fair housing enforcement in over a decade. Mortgage demand softened again last week. Total application volume was down 4.7% from the previous week, even though rates dipped slightly. Here's the breakdown. Purchase applications fell 1% for the week, but are still 14% higher than this time last year. Refinance applications dropped 8%, even though they're still 18% higher year over year. The average 30-year fixed rate came in at 6.43%, down from 6.46%. And interestingly, adjustable rate mortgages, or ARMs, made up 9.5% of all applications. That's up from 8.4% just a week earlier. So, what's happening? Even though rates are holding steady, buyers are clearly looking for creative ways to keep payments manageable, and that's where those ARM options are starting to look appealing again. For reference, ARMs give you a fixed rate for a set period, like 5, 7, or 10 years before they start moving or adjusting. So they're a solid strategy for buyers who know they won't be in their home forever, or they plan to refinance later. Next up, a rare bit of bipartisan good news out of Washington. The Senate passed the Road to Housing Act, short for Renewing Opportunity in the American Dream. It's a major housing package tucked inside the defense bill and includes over 40 provisions aimed at tackling the housing shortage, simplifying federal programs, and expanding access to affordable mortgage credit. Some highlights: expanding small dollar loan availability for lower cost homes and renovations, modernizing the appraisal process, improving coordination between HUD, USDA, and the VA, and streamlining reviews for new housing construction. It's a solid win for housing affordability, and it's being praised by industry groups like the MBA as a win for consumers and the market. So while we're still facing high costs and a tight supply, legislation like this helps move the ball forward. Now let's talk about what might be the biggest rate story this week. Federal Chair Jerome Powell gave us some major clues yesterday about possibly halting the Fed's balance sheet runoff, and that's big news for mortgage rates. Quick refresher, when the Fed does a runoff, they're letting bonds and mortgage-backed securities mature without reinvesting the money. Essentially, they're pulling liquidity out of the market. By pausing that runoff, they'd be adding back some liquidity, which could help lower long-term yields and, by extension, mortgage rates. Powell didn't give an exact timeline, but he did say it could happen in the coming months. With the next Fed meeting on October 29th, just a couple weeks away, and one more on December 10th, that could easily mean before the year's over. If that happens and inflation stays tame, we could see the 10-year dip below 4%, potentially putting mortgage rates in the mid-5s to low-6 range before 2026 is here, and that's a big deal. As of this morning, the 10-year Treasury is holding flat right around that 4.0% mark, and mortgage-backed securities are down just a couple basis points, but relatively unchanged. Technically, the trend still looks positive. We're still sitting above the 25-day moving average, and if we break through the early October highs, there's about 20 basis points of upside room in the MBS chart before hitting stronger resistance. Translation, if this momentum holds, we could see slightly better pricing ahead, especially if Friday's data doesn't throw any surprises. So overall, the data shows steady progress, a more stable rate environment, and early signs of optimism heading into winter months. So to recap, Fannie Mae just gave ADU owners a major win. HUD's staff cuts could reshape fair housing enforcement. The Senate's housing bill could improve affordability and access. Powell might be setting the stage for even lower mortgage rates. That's it for this week's update. Stay informed, stay focused, and as always, stay ready to help you and your clients win in this market. I'll see you next Wednesday.